What's going on, you guys? My name is Hartley, and in this video we are going to talk about order types. We're going to break down all the different options, and I'm going to give you everything you need to know to start your day trading or swing trading career. Okay, so when I talk about order types, I am referring to how your order is placed. Do you want to get in at the market price? Do you want to get in at a certain price, or do you want to stop and get out of your trade at a certain price? That is all dictated by your order type. And so on Questrade, that's the platform that I use, and this is what it looks like here. As you can see, I got a little green box, and it's a drop-down menu that basically gives you a bunch of different options. And so in this video, we're going to break down all of those options. Now, before we get into that, you should definitely consider checking out the links down below. There is one for $50 in free commissions on Questrade. So when you sign up and you open an account, you can try it out completely risk-free, and it will not cost you a single thing, not even for the commission. So if you don't like it, take all your money out and you're totally good. There's also a link down there for 2 weeks free on Skillshare, where you can go through my stock market fundamentals course. There's over 8 hours of content on there, but if you can do it all in under 2 weeks, you get the entire 8-hour course completely free, and you can also have access to the entire platform. So definitely consider checking out those links. There's a lot of really good value down there. But without any further ado, let's start getting into the order types. Okay, so the first order type is probably the most common and the easiest to understand. This is the market order. And so, by the way, I've taken all of these definitions directly off the Questrade website. And so this is what it says. A market order is the simplest of all order types. It allows you to buy or sell securities at the best available price given in the market at the moment your order is sent for execution. So the best use for this is to buy right now. So if you wanted to sit down at your computer and say, I want to buy Apple stock right now, I don't care what the price is, that is when you would place the market order. It is the easiest to execute. It basically says, okay, buy one Apple, and it says, okay, get in and out as quickly as you can at the best price possible. You're basically going to get in at whatever the stock is trading at as soon as you hit that button. That is the idea behind a market order. It's probably the simplest to understand and the most commonly used. Now, the next order is called a limit order. A limit order allows you to specify the maximum price you'll pay when buying the securities or the minimum you'll accept when selling them. So the best use for this is buying dips. Let's say Apple is trading at 100, 100, 100, and you want to place a limit order to buy at $95. Well, this would be your opportunity to buy into the dip by placing a limit order at $95. As soon as the market price drops to $95, it will execute and it will get you into that stock. It is a great opportunity for buying stocks as they go down, or when you're buying a dividend producing stock and you can buy in at a lower price, a limit order is a great way to do that. Okay, the third order is a stop loss order. Now, in my mind, this is probably the most important order that you need to be well aware of. And a stop loss order is a type of order used to buy or sell securities when the market price reaches a specified value known as the stop price. Stop orders are generally used to limit losses or to protect profits for a security that is being sold short. So the idea here is, if you get into Apple at 100, but you know that if Apple drops to 90, it's probably going lower and lower, what you can do is you can place a stop loss order at $95, and as soon as the price gets to $95, it will execute that trade and it will get you out of that position. So a stop loss order is usually an order that is placed after you're already in the stock, and it is placed at a slightly lower price than where you think it's going to go, and that is to get you out of the position. Okay, now the next order here is a trailing stop loss order. So I'm going to read through this and then explain it. But a trailing stop loss order is a type of order that triggers a market order to buy or sell a security once the market price reaches a specified percentage or dollar trailing amount that is below the peak price for sells or above the lowest price for buys. And so basically what this is a stop loss that moves along with your price. So let's say you get into Apple at 100 and Apple starts to move to 110 and 120. You can put in a trailing stop loss order at either a percentage or a dollar amount. Let's say it's $10 in this case. And as Apple moves up to 130, 140, 150, that trailing stop loss will always stay $10 behind the highest point that stock moves. So if the stock goes all the way up to 150 and you have a $10 trailing stop loss on it, and then the stock starts to dip a little bit, you will keep a stop loss at $140. And if the stock falls all the way below 140, it will get you out right at 140 as long as there's no big gaps up or down overnight. I personally use trailing stop losses to get out of my positions because if the stock continues to go up, it moves my stop loss up with it and I'm allowed to capture that upside. However, if the price begins to move down, it locks in the profits that I have and it gets me out at a reasonable level. Okay, now the next order here is a stop limit order. I personally don't recommend using this one. It's a little bit more complicated and it doesn't really fit into mini trading strategies. I'm going to read this out for you here though. A stop limit order combines a stop order with a limit order. With this order type, you enter 2 price points, a stop price and a limit price. If the market value of the security reaches your first stop price, it automatically creates a limit order, which is your second price point, and as long as it happens within the specified duration of time. And so what's happening here is you're basically saying, at this first price point, I want to trigger a new order to appear, and at this price point, I want that order to execute as long as it fits within this day. Now, there are very, very few situations where this type of order is actually going to benefit you. That is why I do not recommend using it. It's very, very rare that this actually works out. And it's kind of like trying to limit your losses, but it's just a weird situation. So personally, I don't recommend using this one. You don't really need to know about it. And I would just focus on the other ones that I'm going through here. Now the next one here is sort of similar. It's called a trailing stop limit order. A trailing stop limit order is a type of order that triggers a limit order to buy or sell a security once the market price reaches a specified dollar trailing amount that is below the peak price for sells and above the lowest price for buys. And so basically what's happening here is you're doing sort of the same thing, but instead of a limit order, it is going to be a trailing limit order so that hopefully it can go up with your price here. This happens a lot when your price dips drastically after you buy in. This can then be a good opportunity for you, but again, it's pretty rare. It doesn't fit into many strategies, and most of the time you're much better off cutting your losses quickly and getting back in at a better opportunity rather than trying to pull out one of these stop limit orders. Now the last 2 orders that I want to go through here, I do recommend definitely depending on your trading strategy. So the first one is a limit on open order. So when you place a buy order with a limit on open order, you are setting the maximum price you're willing to pay. If the market price at open on the following trading day is at or below the maximum price that you set, your order is processed. If the market price is above the limit you set, your order is canceled. So this is usually the type of order you would place when you are after hours or you're late at night or you come home after work. You want to get into, let's say, Apple if it opens up tomorrow below $105. But if it opens at 106 and it gaps up big like that, you don't want to get into it. That is when you would use this type of order. It's usually when you're late at night, you're after hours, or you can't make it to your computer, and you want to get in tomorrow as long as the stock is below a certain price. That is when you place a limit on open order. Now the last type of order is a limit on close order, and so when you place a buy order with a limit on close, you're setting the maximum price you're willing to pay if the market price at close on the current trading day is at or below the maximum price that you set. Your order is then processed. If the market price is above the limit you set, your order is canceled. And so basically what this is for is buying in at the end of the day. So if Apple has a massive, massive drop and you say, okay, I want to get into Apple, but if it shoots back up, I'm out. That is when you would use the limit on close order. This is really good if you're buying into cash flow producing assets such as dividends or REITs. That is usually when I would use a limit on close order, but most of the time I'm day trading or I'm getting into it quickly while I'm sitting at the computer. So I very rarely use the limit on close order or limit on order open, but they are great if you're working full time or you can't make it to your computer, whatever the case is. These are the type of orders that you may want to use in that scenario. Now, if you're trading from home and you're looking for a community of people to share ideas with and learn from, you should definitely consider signing up for my Discord chat. I send out a weekly watch list as well as sharing my daily technical and fundamental analysis, as well as my company comparisons and a ton of resources. So if you are interested in signing up for a Discord chat and joining a community of traders, it is $5 per month, and you can hit the little join button down on the YouTube there, or you can check out my website, zachhartley.com. It is also linked below, and I would love to have you there. There is tons of conversations going on for every type of trading, and I am on there every single day. It is open on my computer. So if you're interested, $5 a month, I'd love to have you join our trading community. Now, in summary, you need to make sure that you understand these different order types. I know that there's a lot there, and the best way to practice them and use the different kinds is to use a practice account. That way you can make as many trades as you want. You can buy in and out of them immediately and right away. It doesn't matter at all, and this way you can get familiar with how they work. So if you don't have a practice account, you should definitely sign up for one. I've been trading for 7 years, and I still have one that I use to play around with and test out different strategies. So if you guys got any value out of this video, please consider hitting that like and subscribe button. I sincerely appreciate it, and it really helps out my channel. Thank you so much for watching, and I will see you guys in the next video. Peace.